Bring in former president of the Federal Reserve Bank of Dallas, Robert Kaplan. Robert is also the co-chair of the Draper Richards Kaplan Foundation. And let's talk, Robert, just about one thing that Rick just said. He said he thinks the Fed has done a great job of cleaning up its mess to this point. And that's something he's given them kudos for. I think you have real concerns about whether the Fed is going to be able to clean up the rest of the government's mess at this point. You want to talk a little bit about your concern about what the Fed is fighting and maybe how the rest of Washington keeps creating that problem?
Yeah, and I agree with Rick. I think the Fed has done a good job once it reversed course, getting on the right path. The issue is, and the challenge that they're dealing with is we're running a very large deficit, in excess of 7% of GDP this last year and probably higher next year. And the fact is that accommodative fiscal policy blunts to some extent a very restrictive monetary policy. And so the reason I think Jay Powell did the right thing to leave the option open down the road that they may have to do more, I think there's uncertainty about the effect of continuing to run these large deficits and very accommodative fiscal policy. And then there are other factors like the fact we're structurally undersupplied on fossil fuels globally. And will that vulnerability turn out to raise costs also? So there are issues like that. But as the saga moves away from focus on the Fed, I think we should realize the issue with very large supply of treasuries for years to come and potentially having to pay higher rates and certainly higher interest expense at the federal government level as that debt reprices. That issue is going to be with us for an extended period of time.
How long? And is there anything the Fed can really do about it? What should they be doing? Well,
so it's interesting. The Treasury yesterday announced a restructuring in the maturities they're going to offer. So they're trying to manage through this. But there's limits to what the Fed could do. But I would say this. The federal government is very sensitive to how much longer the Fed keeps rates higher. So, and I think the Fed is going to need to keep rates higher into a meaningful part of 2024. But as they're doing that, the federal government keeps repricing these maturities. And we're going to go from $620 billion of interest expense in 2023 to, say, $750 in 2024 on our way to $1 trillion. And that's a real structural issue at the federal government level on how do you spend for entitlements, how do you spend discretionary, and be approaching interest expense of $1 trillion. And no, the Fed can't do a lot about that. When the Fed is able to ultimately begin lowering rates over the next couple of years, that'll give some relief to the federal government, but not until they do that.
Hey, Robert, the latest GDP number, the jobs number, it's been posited that we are the strongest on a relative basis, one of the strongest economies on the planet, best to come out of COVID. We came out most quickly. That makes me happy, and I want to believe it. It's a problem for the Fed, obviously. But is it real organic strength in the economy, or is it Keynesian? You said it last time, how much we spent. Is this purely a function? And, you know, Keynesian spending, eventually you got to pay it back, and you got higher interest rates, and it, you know, it becomes a problem. And I think you end up behind where you started sometimes. Is that what we're doing, or are we doing really well?
Well, we've got naturally a very strong economy. We've got the strongest companies in the world. We have lots of innovation. But there's a reason we've outperformed also the rest of the world. We did more fiscal stimulus and a substantial amount of monetary accommodation. And the fiscal stimulus continues. So the organic growth rate of the U.S. economy is probably lower than it appears, and we probably won't see that until we start moderating some of this fiscal spending. But we should be aware, yes, some of this is artificial, and the bond market has been politely or not so politely pointing that out by saying we're going to charge you more for the debt because you're running such large deficits.
Do you think that message is being heard in Washington? Because that's not the feeling I get.
Well, it is a sensitive subject, but obviously we're heading into an election year, and there's the one thing all this fiscal spending does, it makes it less likely that we're going to have a more material slowdown in the economy. The Fed would like a slowing economy. The fiscal spending keeps the economy more resilient. But the fact that you saw yesterday, the Treasury very explicitly changed the nature of its issuance and the supply and the maturities tells me they're very aware that there's a sensitivity in the bond market for how much supply is coming.